We had a property management partner steal tens of thousands of dollars in rent from us. And by the way, they turned right around and declared bankruptcy. There was nothing we could do about it. And yet, despite all of that, we were able to exit our Cleveland fund 4 years early, more than doubling our investors' capital. We gave a 132% return, about 22% a year, to our investors, and they got a lot of it in cash flow along the way, by the way. By the way, this is not just about Cleveland. This is about any emerging or distressed type of market, from Chicago to St. Louis to Birmingham. I don't care where you're looking. There are lessons that are hard won for me, but I want to relay to you to make you a better investor so that you can see what you're really getting into in this multifamily game, whether you are looking to invest in the space or whether you're actually looking to buy your own property. So hopefully this is valuable to you, but let's dive right in because I have a lot to share with you today. So first things first, let's go back. I want to take you to 2020. COVID has just shut down the world and people are kind of on the fence a little bit, but capital is starting to mobilize. Remember about the summer of 2020? Well, that was the point that people started to pour into the Sunbelt markets. I'm talking about Nashville, Phoenix, Dallas, a lot of those sort of boomtown areas. And capital started to flood into those markets. Population was booming, jobs were being created, and rent growth was really starting to hit double digits in those places that was attracting a lot of investor demand. Now, if you were an investor, the playbook at that time felt really obvious. Follow the wave of growth, buy in the hot markets, ride the wave. And a lot of smart money did that. At the same time, we raised a small multifamily fund to buy affordable housing in Cleveland, Ohio. And the response was, well, let me just say, it was nobody congratulating us. The most common reaction was something along the lines of like, why on earth would you buy there when you could just be targeting stuff in Austin or in Florida or whatever? And we heard this from friends, we heard it from investors. I mean, I heard it from, people in our own network who thought that we were kind of insane for doing this. Yet, the question that very few people were actually asking at the time is what happens when every developer and syndicator in the nation is working off the same data and growth signals at the same exact time? And that's what we're seeing today. But the hindsight, of course, is 2020. But it's that they all build at the same time in those same cities. And you have this supply wave where rents actually have been falling because there's been so much supply built in those markets, despite the fact that the demand had increased a lot from tenants. And so that's exactly what happened. So now 9 of the 10 worst performing rental markets in the country are Sunbelt cities, and negative rent growth is going across the board. Now, this may not last for 5 or 10 years, but it's certainly impacting the market today. Now, on the other side of the coin, Fortune has published a piece recently calling out the affordability economy. And their data has showed that 28 of the 53 largest metros posted price declines over the last year. And every single one of those is in Florida, California, or Texas. Now, the markets that are going up, Cleveland, Kansas City, Pittsburgh, Milwaukee, right? The places nobody was excited about 5 years ago, and maybe they're still not that excited about them. But generally speaking, these are places where there wasn't a lot of building happening. So what's the difference? It's basically one variable, supply. But supply is what drives our market today. And so that Sunbelt growth is very real, but when rents spiked, developers have responded at a pace that's just too fast for the market to absorb. And as a result, things have really kind of stagnated in those areas. Now take Cleveland. Its construction pipeline sits at 2.3% of its existing inventory. The national average is north of 3.5% even today. So nobody overbuilt in Cleveland because nobody was excited about Cleveland. And that lack of excitement actually formed our entire thesis. There was this second layer that a lot of people missed. And basically we saw this when we were building our portfolio. We were focused on government subsidized housing. That's where the government will step in through programs like Section 8 to help pay the way of a tenant. They might pay 70, 80, even 100% of that tenant's rent on time every month. Now, most investors that we talk to hear the word subsidized, which is government subsidy tenants, and think discounted or shouldn't be worth what it's worth at market or whatever. They assume that that means lower rents. But what we've found in our research before we started this fund in Cleveland is that the opposite is true. Government-backed housing vouchers in our market were paying above what we could get from private tenants. In some cases, we were achieving 30 to 40% more rent per unit than what we could get on the market. And those payments kept coming in COVID, by the way, when private landlords across the entire nation were having trouble collecting because of eviction moratoriums and different things like that. So we had this rent floor that was higher than what was available on the open market. And in buildings we bought, we were essentially buying things at a fraction of the price that it would cost to build them today, renovating them to be at the standard that these Section 8 or government subsidy programs allowed, and then putting subsidized tenants in at much higher than market rates. In a city, by the way, with almost no new supply coming on. That's not a hot take. That's just basic math. But sometimes the basic math is so unsexy for people to hear that they actually completely ignore that it's a fantastic investment. And that was our premise. Now, here's the part that very few people talk about. That math I shared to you, it looks beautiful on paper. And a lot of people in the industry kind of stop right there. They show you the spreadsheet, they show you the returns, the thesis, and that's kind of what you see. But what they don't tell you is what it actually takes to earn the return from when you buy to when you sell. Because the real risk in real estate, it's the hold period. It's what happens at the property. It's how you manage, it's how you operate. And in our case, just about everything that could go wrong did go wrong. So I want to walk you through what really happened inside this fund. And it's not because it's a fun thing to talk about, but it's because every investor deserves to understand what their capital is actually going through and the caliber of the person that's managing or the people that are managing it. Because honestly, I think that the fact that we survived all of this and delivered meaningfully more is more valuable than the return itself. It's the lessons, it's the pattern recognition, it's the management ability and the ability to take that into new situations that I think is really, really valuable. So what this fund actually was an assemblage of 20 affordable multifamily properties across the greater Cleveland, Ohio area that we started to accumulate in 2020. We bought individualized properties. We typically bought them pretty distressed. We'd spend close to the amount that we spent to buy the property in renovation costs. And the thesis was really simple. There's a huge backlog of tenants that have government subsidized vouchers that don't have places to live. So the government vouchers are paying above market. The building prices are so low that even in the worst cases, we could get our money back. And that was the focus. And let me give you an example so I can make it tangible. These are small multifamily properties. Our first property, we acquired it for $105,000. It's a 6-unit property. I mean, imagine what it would cost to build that. Probably 10 times that amount. But we put about 40 grand into the renovation on this property. This building sold for $350,000 based on its income, which, by the way, is still a great deal for the buyer because it's kicking out cash flow. But these are the kind of metrics that we were looking at. Another was a $55,000 acquisition. We put 35 grand into it, sold it for nearly 300. And again, we were able to create cash flow streams that turned these into 15, 18, 20% cap rates. Right? The numbers are just phenomenal if you can do what it takes to manage the property. But here's what it took to actually earn these results. Let me give you an example of the things that can go wrong and have gone wrong. In one case, we hired a contractor to renovate a handful of our units. He took the job, it took weeks, and he ultimately didn't finish the work. He actually kind of gave up halfway through, wasn't able to even do it. And we kept trying to work with him. We kept trying to say, look, we'll give you more time or give him chances to make it right. But ultimately this guy refused, and he just wasn't going to finish. So he was still demanding payment though, as if he had completed the job. And we refused to pay him without fully completing the work, because we're saying, look, you promised us this, you haven't delivered it. Why would I pay you the full amount? Well, he went back in to 2 of our units and absolutely trashed them. He let water run through and basically flooded them out, destroyed some appliances, destroyed some of the wood fixtures. I mean, just caused damage everywhere as sort of a retribution for us not paying him, even though he didn't complete the work. And yet that was the kind of thing that we had to deal with in this market. Or separately, we'd get something like a unit fully renovated. We'd put new appliances, we'd have it ready to go, and we'd start marketing it to tenants. And before we could actually get somebody placed, somebody would break into that property, steal the appliances, maybe steal the copper out of the AC. And this would happen like not once, but multiple times a year. So you're talking about buying brand new refrigerators and stoves, putting them in empty units that you need to do to get a tenant in, and then having them get stolen before we could even get that unit placed. This is the tough side of real estate management, and this is why it actually pays to be a passive investor, because dealing with the headaches and also having a full-time job or a company is no joke. This is very, very challenging stuff. Or let me give you another example. We went through a property management search because our existing manager was having trouble keeping up with the pace of our growth. And we spent months vetting contractors and property managers and finding the right folks for this part of the team. Now, I'm talking reference checks to 3+ investors that work with them, rounds of interviews, and we finally found a company that we felt great about. They were established in the local market. We really felt like we did a very, very robust set of diligence, and we moved half of our portfolio over to this group. Now, they went bankrupt within a year, and this is not just, hey, we're done, go find another property manager, but we're talking about collecting a couple months worth of rent from our tenants and never passing it to us. We were getting ready to cause a legal action just to get them to pay us. And ultimately, they closed the door and basically cut us off at the pass so that we couldn't even get retribution for the stolen rents that they had taken from us. Now, we estimate that they cost the fund maybe $100,000 between the rents, the property damage, the deferred maintenance, all the stuff that they created, and the properties that were under their management fell into distress that we then had to take back to a different group to get them back on track. So it was really a majorly challenging situation. And it was one where me and my partner, Anthony, looked at each other and said, what are we doing here? Like, this is the big leagues of managing distressed, Class C, D+ type properties in emerging markets in Cleveland. And this is something, by the way, that you could see in any up and coming market, the same types of things. But from managing this portfolio from 2,000 miles away, this was a major challenge for us. And we had to get on planes and be out there to make sure that we could keep our management on track and ultimately keep things moving forward. So, even with that, you would think, well, that's got to be the most of it. Well, there were eviction situations where the tenants had not paid rent for months and were threatening our property management team, where we had personal safety issues. These are the realities of operating in markets that tend to be, really good cash flow, and they're up and coming. And from these experiences, we basically rebuilt the fund's operations from scratch. We had to find new management. We restabilized the portfolio that was stable when we had brought it over. And then we did it again. And we just kept showing up. So anyway, why am I telling you all of this, right? This is not the typical like big return story because everybody did great in this fund. But basically, I want you to take away some of these lessons. That if a property manager had not stolen from us, I mean, this fund's return would have been well over 30% a year to our investors. We left real money on the table because something was totally out of our control. Yet we still delivered 2.3 times investor money, 22% annualized to every single investor in this fund. And we exited 4 years ahead of schedule. That's not because we ran out of patience, but it's because the operating environment itself shifted in ways that started to make us more concerned about long-term ownership in the Cleveland market. And instead of holding through and collecting fees, we actually sold into a position of strength and returned our investors capital much earlier than they expected. That is real operator alignment, and that's what we try to do within everything that we are focused on. So now I share all of this for really one reason, and it's to show that this experience is exactly why I operate the way I do today. I learned that operating risk is extreme in a lot of markets, and it's not the version that you read about in the glossy case study. This is the version where someone steals from your fund, where you have to rebuild at 2 a.m, where you have to reconcile the books. It's also why I believe so deeply in vetting operators with the same intensity as vetting the deals that they are investing into, because the building doesn't steal from you. People steal from you. The market doesn't threaten your team during an eviction. Tenants do. The spreadsheet does not go bankrupt. Your manager goes bankrupt. These are the problems that happen in these buildings, and we need to be aware that not only is it not sunshine and roses, it could be a painful, rocky road the whole way through while you work towards your headline exit. And you want operators that are going to be able to weather that storm with you in the trenches, on the ground. So if you're evaluating where to put capital, here's what I would tell you to do. Don't just look at the pro forma, look at how the sponsor handles deals when they go sideways. Ask them about how they've dealt with adversity. Ask them the most painful lessons they've learned. You want to hear pain, because if they haven't shared any, then there's a good chance they don't know what to do when it happens, or they're lying to you. Ask them to tell you about their worst days on the job. And if they don't have one, then they really haven't been tested, and that should be a red flag for you, or at least it should allow you to take pause and really think about what you're doing. And you probably do not want your money to be the test of that. So some practical takeaways for you with all of that. Before you put any capital to work in real estate in 2026, I want you to ask yourself 2 questions. First is, am I paying for growth that's already priced in? Or are you buying cash flow at a discount to what it would cost to build today? This is a really important question. And if the only way that your deal works is for rents to keep climbing and rates to come down, you are making a bet on that market, and you probably don't have a stellar deal. Now, if something works today at today's rates with zero help from future conditions, you might be onto something. Second, has your operator been tested? And I'm not talking about on paper, I'm talking for real. What has caused them to lose sleep? Have they rebuilt? Have they had their worst day and still delivered positive returns to their investors? Because what I have just shared are things that cut me up for nights and nights and nights at a time. And yet we still delivered a headline exit in a really, really tough real estate market in 26, right? And then the Sunbelt, and all of us that are reeling from investing in this sort of domain the last couple of years here, has taught an entire generation of investors what happens when you pay for growth and that growth stops, or that supply gets oversupplied. Whereas the Midwest is quietly teaching a smaller group that's attracted to a lot less of this, less sexy investments, what happens when you buy value and you're able to basically survive to see that through and let the market catch up. So last, if you're thinking about where to put capital this year and you want to see where you're standing, I built a short assessment, sort of an investor quiz about what might be best for you and your goals, check it out, www.oceanridgecap.com/quiz. I will put the link in the bio, and we will talk to you next time.